So the S&P 500 this year is up over 13%. However, when we all opened our September statements, we saw probably about a 5% decrease just in the S&P 500 alone. So that's causing some concern, right? Because everyone is now used to climbing markets again, and we're kind of forgotten about 2022 at this point. In fact, over the last year, the S&P 500 is up nearly 19% over the last 12 months. So this is a good time to kind of take a refresher and look at what we expect to happen through the rest of this year into early next year. One of the best sources that I can send our viewers to is Vanguard. They have a great research department, which we've linked to in this video. Also, it's important to recognize that investing for 3 months or 6 months or even just a year is not really advisable. Your money really shouldn't be in the markets if you need this money in the next 12 months, even I would say potentially 3 to 5 years. That money should be out of the market too. Ultimately, we have to be long-term investors, and it's kind of come cliche, right? A lot of advisors use that as oh, you're a long-term investor, don't worry about the loss in your portfolio. Well, emotionally, we're very susceptible to those losses, and nobody likes losing, right? So in the end, the saying is right. I think it's applied too much at times, but the saying is right. We do have to be long-term investors. So let's take a look at a couple of things in this latest Vanguard market update. In fact, I'll show you 2 slides on the screen now. These are 10-year projections of different asset classes. And the first one is stocks. So right now, for the next 10 years, Vanguard is expecting large cap U.S. equities to earn 3.7 to 5.7% per year over that time period, deviating at times by 16%, meaning there's going to be volatility ahead. And those aren't volatility numbers that are not really historical, meaning that those are normal volatility numbers. Small cap stocks, 4.3 to 6.3%, but they could be 22% above or below those numbers. Emerging markets, which in our own portfolios seem to be getting smaller and smaller because of all the struggles in those countries right now, but 6.2 to 8.2%, but 26% volatility. The bottom line is that over the next 10 years, there's not any projections by Vanguard or any other major asset managers showing big negative returns. And that's a reason for that. Historically, the stock market's never lost money over 10 years. And therefore, we have to be patient investors. But while being patient, we also have to understand what's happening around us in the short term. Right now, Vanguard expects year-over-year inflation, core inflation, to be around 3.6%. They expect the Fed to hike up interest rates by 25 to 0.75%, targeting a 5.25 to 5.5% Fed rate number, which is a 22-year high in our country right now. In fact, there's a lot of young people have never experienced high rate environments. If you think about that as an older listener, we have many clients who had 12 to 14 or even higher mortgages, interest rate mortgages. As far as rate cuts, people have been talking about that all year long, that the Fed might cut rates. A lot of people believe they'll happen the first of next year. Vanguard doesn't believe that, most likely. No rate cuts until the second half of 2024. And that catalyst for that rate cut would be a recession, or possibly because they're able to get inflation to come back down to their target number of around 2 to 3%. Vanguard believes that it's probably more likely to come down because of inflation, because of a recession. Chances of a recession historically by them has been 90% looking forward over the next 18 months, but they recently revised that to 70% chance of a recession over the 18-month period. So the bottom line is there's going to be volatility ahead. There's going to be a lot of news articles based on fear to make you act, whether it be to buy their product, to buy their newsletter, whatever it is, when they're advertising gold at 2 o'clock in the morning on the Fox News channel, they're not really giving you economic advice. They're trying to scare you into buying their product. So we have to keep that in mind. Who's writing the articles that we're reading? Are we reading articles that are really unbiased as far as economy goes? As we enter the election season, a lot of economic articles are going to be steered toward politics and trying to scare you into doing something. Bottom line is, we focus on State Street, BlackRock, Vanguard. Those are all 3 good economic sources that don't have an agenda coming out of those departments on their economic forecast. And then obviously make sure you have enough cash. Build cash reserves. If you think there's a recession coming, if you're unsure about the economy, then maybe you carry 6 months to a year's worth of your living expenses if you're that concerned. But for most of us, 3 to 6 months is usually a good range. Anyway, bottom line is, don't be scared. If you're still working, this is an opportunity to buy more shares, and you get dividends on the number of shares that you own, not the price or value of the stock. Thanks for watching. Reach out if we can be of any help.